That's all private. Okay, the thing about asset protection, remember I said people talk too much, give out too much information, you're giving out too much information. Who's taking title of this property? Who are we entering the agreement? 732 trust. Period. Don't tell me anything else. Because then they're going to try to get into the tent. And once that camel gets in the tent, you're not getting him out of your tent. He's just going to start rutting around in there. So, how do you take your name off title? Well, I talk about the wholesale trust. Well, we just use a different type of trust called a land trust. Now, if you wanted to, you could check LA County, and if you ran my name through the county recorder's office, you're probably going to find them on, I don't know, 100 properties down here. And I don't own any property in this county. I own property in Riverside, but I don't own any property in LA County. Those are all my clients. My clients own all those properties. So what we do with our clients to give them asset protection or anonymity is we create an anonymity shield around their assets, and it's done through what's referred to as a land trust, although you should never call this a land trust whenever you're speaking to an attorney, CPA, mortgage broker, because they don't understand them. All right? They're recognized under California law. I can give you case law to back it up, but the fact is there isn't a statute here. If you understand the way attorneys think and operate, if you go into the office and you say, hey, I was at a real estate class on Saturday, I learned about this tool called a land trust, what do you know about it? You went to a real estate class and you think that speaker knows what the hell he's talking about. Okay. Where is he from? What state? I guarantee he's not even from California. You're right, he's from Washington. See, there's your answer right there. That's about how it's going to go. Why? I guarantee it'd be a completely different scenario if you walked in and you said, sir, would you do me, I want to hire a service. I'm willing to pay you $7,000 to research the validity of land trusts in California and see how they work. And then you write out a check in his name. I don't think he's going to tell you, this is a waste of your money to give me $7,000. He'll probably look at it and go, can I negotiate this today? All right, is this going clear? That's the way they operate. If you come in there and you expect them to give you free advice on an area in which they're uncomfortable with and they've not researched and studied on their own, their safest answer will always tell you, no, you can't do this.
Actually,
Yeah.
if you have a bunch of properties in your name through those land trusts that are really other people's properties, what if somebody sues you? Because they're in your name.
That's awesome. So what happens if I get sued? All right, so here's the way a land trust works. We title property in my name, so Clint Coons, trustee of the XYZ Trust. That's how title's taken in the name of the property. Your name is Mike? Oh, Brett. So Brett, you're the beneficiary of this trust. So what it's set up on, here's the trust, and it's got Clint over here, I am the trustee, so we'll put a T, and then Brett, you're down here, you're the B, you're the beneficiary of this trust. Right? So now, we're set up like this. Now the property goes into this trust. Who controls the trust?
The person
Trustee. So that's what we've been ingrained to think. A trust is a contract. You can write it up any way you want.
Right.
Okay, most trusts are set up with the trustees in full control. That's not the way you create land trusts. So you could if you wanted to. That's not the way I create them. The way we create them is that the beneficiary is the one that has all the control. That's you.
Right.
Now, it's also set up that once I record title in the name of the trust, I resign. I quit. I don't want to be on your property. I don't want to be associated with it. So when I resign, we have the successor trustee already appointed to step in to fill my shoes. And who is that? Brett? It's you. It's you. So then you step up and you're the trustee, but that information isn't disclosed anywhere because it's in your private trust document. I've stepped down, you've stepped up, and nobody knows about this. Now, the elephant in the room that some of you are thinking about is, well, what the hell happens if Clint won't step down? Right? He's going to run around, he's going to try to sell my property. Okay, first off, I have a law license to protect. I'm not going to give it up over $10,000 in a piece of property, $100,000. Okay, it's not worth that, number one, so that's common sense. But two is, it states that in the trust agreement, I can't sell your property. Okay, that's just written in there. So anybody who's trying to deal with me as a trustee would see the copy of the trust agreement that says, Clint can't sell. Only person that can sell is Brett, because he's the beneficiary. So, number one, there's a protection. Two, you fire me. You have that power to remove me at any time if I don't remove myself. So those are the protections that are inherently built into that trust.
If
Now,
you
if
were
I get
sued, if you were sued, would Discovery allow them to have a copy of that agreement? Would the trust agreement.
Depends on the nature of the lawsuit. If the nature of the lawsuit surrounded the property, absolutely. But if it's the nature of the lawsuit has to do with me running somebody over in Washington State, not at all. It's not relevant. Not relevant, so they can't get it. See, one of the things that you have to understand too about lawsuits is that the assets that you hold, if somebody brought you into a dep and said, what do you own? You don't tell them. It's not relevant. Okay, your counsel would object and say, the purpose of this deposition is to establish negligence on behalf of my client. Okay, that question does not lead to whether or not he was negligent at the night when the harm occurred, what he owns. What are you trying to assert here, counselor? That rich people run over people more often than poor people? Or you just want to find out how much I own so you can then pump up the damages on your side of the coin? The only time they can find out what you own is when they've won and they get a judgment against you. Then it becomes relevant information. So that's why an anonymity shield where you don't appear to own anything is so powerful. I can tell you, land trusts serve that purpose. So when you take existing property, you can transfer it into the trust and take your name off title. And I go on there, and then nobody knows that you're the owner of the property. So that works as well. You'll still be in the chain of title. The only time it causes problems if you want to refi. If you want to refi the property, then you have to go on title. Otherwise, they won't refi the property for you. I mean, this stuff right here, it's been used to protect a lot of people, and it's been used, in some cases, to do harm. You know who Dennis Hastert is? Mm-hmm. Former Speaker of the House, just been convicted, corruption charges. Okay. What did he do? Anybody know the backstory? He created some land trusts. So Dennis Hastert went and created all these land trusts in Illinois in a particular county to buy a property, bought up all this property, and then pushed through this federal funding bill for a highway to go through this county. And it just so happens I went across all the property that he owned. Imagine how something like that occurs, right? But he couldn't get that through, of course, if you saw that Dennis owns the property. So we created these land trusts with attorneys listed as the trustees. Now, the attorneys were not in on it. They didn't know that this was the purpose behind the creation of these trusts, and they bought up all this land. And so these people that live in this county that didn't want this freeway project to go through, they're coming up with every claim they can. Oh, you can't put this through because there's a mosquito we're going to impact. You know, whatever we do now to stop them. Oh, earthworm, can't have that. So they were, this project was 7 years down the road into this project that should have been built probably in a year. And finally somebody got wise and they start looking at all the owners of title. And they see all these land trusts, and they go, well, we don't know who owns them because they're all hidden behind Clint Coons. Well, not me, but somebody like me. But they screwed up on one of them. Screwed up on one of the trusts. So when you create this type of structure, it's not saying, and you go out and do it on your own, but if you don't know the ins and outs of it, you'll probably screw it up. He might have done this one on his own. On one of the properties, they put his wife's address. She owns this house, and I forget, maybe it was in Louisiana. They used that address for the property tax statements. So what they did, that was the thread that unwound the entire ball of what he created, because he traced it back to his wife, and then it just started going and going and going and going. That's how they caught him. Now the project was shut down. So when you set these up, I mean, there's a lot of little steps along the way, but I can completely remove you from title when you use a land trust. And so that's the first step in anonymity. Now, the other thing you can do is if you're creating limited liability companies. Anybody ever set up an LLC in California? No? You have? Is your name on it? Absolutely it is. All right? Your name's on it. See, genie's out of the bottle. That's what I'm talking about here. When you set up an LLC in California, your name has to go on it. It's just a matter of law. So what we like to do a lot of times is we create a holding LLC here in Wyoming or Nevada. And the reason we do that is because when you use those jurisdictions, if you read the paper, Panama Papers, you heard about that? And they kind of trace that back to Nevada. There's the same law firm in Nevada that was utilizing setting up LLCs in Nevada for clients because you provide what's called anonymity. That is, the state requires that you either list the managers or the members on an LLC. So when I set up an LLC, I'm going to make it a manager-managed LLC in Nevada or Wyoming. We have to list the manager. Well, the person we use, his name is A.T. Mathis. It's Toby Mathis. He's my partner. He started the firm with me. He's on 17,000 entities registered in that state. 17,000. If you type A.T. Mathis, Secretary of State of Nevada, Wyoming, and just start going page after page after page, you'll see his name. Now, he doesn't own those. Those are our clients. I mean, we own some of them, but not nearly that many. Those are all of our clients that we've set up structures for. So he's on there, just like the land trust, we're on there for filing, then he resigns. So our clients then take over control, and no one knows that they're involved with that entity. So that forms your base level shield. And then from there, we create the in-state LLCs where the property is going to be held. So it looks like this. Now all of these LLCs that we create in these various states, they all point back to Wyoming. So if somebody looked at your California LLC, it would say, hey, it's owned by a Wyoming LLC. So they wouldn't see your name associated with it because we file them as member-managed LLCs. So they say, well, who's the member? It's Wyoming. All right, so let's go to Wyoming and pull up that LLC. Who owns that LLC? Well, this A.T. Mathis guy is the manager. So nothing points back to you. And that's how you build an anonymity shield. So when you own assets, like my client in LA and his father now, all of their information is held behind land trusts and Wyoming LLCs through California LLCs, just like this. One property per LLC, you cannot find out anything. In fact, my client now is so paranoid, the other day he was hit, he was coming out of the bank, it was a setup, and a guy walked up to him and said, hey, I think your tire's low. And he didn't think anything of it, started driving down the street, got about 2 miles, and his tire blew out on him. So he's out changing his tire. Got his tire changed, jumped back in his car, drove to the next bank, and he had a backpack with about $30-some thousand in it in cash, and deeds to some properties, title to a boat, and I forget what else is, concealed weapons permit, a few things. Somebody had snagged it. When he was changing his tire, they'd snagged it out of his car. As he got there, the backpack was gone. So it was there when he left the bank, it was gone. So we figured it was a setup. Somebody had done something to his tire, and made him think about that. So when he got down the road, he went to change the tire on his own, and reached in, grabbed his backpack, and they were gone. Now, he's a little concerned now because a lot of that information is stuff that we've removed from the public record, so nobody knows that he owns it. And now that that can get out there again, what he wants me to do is go through and actually start changing the titles around, putting them in different land trusts and using different entity names. I mean, he has the money, he doesn't care, just to re-engineer the entire structure now, so no one will know who's the actual owner, how to find it, and moving the shells around. So this is what you do. You're buy and hold real estate. Typically the way we set them up is we use land trusts into LLCs, so the land trust then owns the LLCs because the land trust does not provide asset protection. A land trust is for title holding purposes only. Okay, that's all it does. The LLC provides the asset protection. And then the reason why we use the Wyoming LLC is because California LLCs, number one, your information is publicly available. Two, you have no charging order protection. So what happens outside the box doesn't stay outside the box in California. So if you set up an LLC in California and you're involved in a personal lawsuit, they can take that LLC from you. So we protect that by using a Wyoming LLC. So in my example here, if I did something like this, Brett, for you, so we set up some LLCs here, and I have them all down here in this Wyoming LLC, and I put you right here. How many LLCs do you own?
One.
One. You own one. You'll own this LLC right here. This LLC owns all of these LLCs. So if somebody ever questioned you, how many do you own? Well, I'll have you listed here as the member, but you're not listed here as anything other than the manager. The member manager of this one. So on these, all these operating agreements, it states that the member manager, the owner of them, is this Wyoming LLC. So you own the Wyoming LLC owns all of these. So you actually only own one limited liability company. And from a tax reporting purposes as well, depending on what your concerns are, it also helps you to avoid audits when you set yourself up this way. So many times I'll have this filed as a partnership for tax purposes. When you file your Schedule E, if you list you have real estate in your own name or you use disregarded LLCs, they all flow down to you. They show up on page 1 of your tax return, on page 1 of your Schedule E, so they all get listed there. That's just basically telling the IRS, if you got nothing going on this month, you want to fire another audit against a real estate investor, pick me. So I like to use partnerships because when you have a partnership, it shows up on page 2 as a line item, one line item. It's on page 2 of your Schedule E. So it decreases your risk of audit. A lot of things that people mess up on real estate investors is the CPA that they're working with does not understand taxation. And as it relates to the IRS, what are the IRS audit triggers? I mean, The IRS came out in 2011 and specifically stated they're going to target real estate investors, and they've done one hell of a great job at it. And they've gone after real estate investors and nailed them for all kinds of things. Most of it's record keeping, not have an aggregation election in effect. So if you have multiple properties, make sure you have an aggregation election to treat all of your properties or activities as one activity. Otherwise, if you're taking certain deductions on your return, they're going to come in and challenge you on that, saying you didn't spend enough time. So that's really important when it comes to real estate taxation. And then documents. Every time you go out and drive around, make sure you have a log. If you don't have logs for the time you're driving and you get audited, they will disallow those deductions. They've been doing it time and time again. So time logs that you spend on real estate, especially your driving logs, mileage logs. Yeah.
Is there anything that you talk about as far as your association with Scott Estel and auditing and tax-related issues? I don't know if he's really part of your company, but I know there was some association.
So he's an associate of us. So Scott Estel is a former IRS attorney. We have actually IRS attorneys on staff right now. He is someone that we use when it comes to for audits. I've used him personally. I used to be an avid stock trader. So when the stock market was hot, I was trading. 1 year, I made close to $1 million in trading, and in that same year, I gave it all back. Yeah. I give it back. It took me 6 months to make it. It took me 6 weeks to lose it. All right. And I called Tracy up. I flew from here, from Seattle to Miami or something. I'm $700,000 back rated in 1 day. So I traded naked options. But it was great when I was doing it. $40,000 days before noon. It was addictive. But the point is, I got audited because the IRS does not understand stock traders. And they came in, they said, where are all these stocks that you own? I said, I don't own them. Those were options. I never actually took title to the stock. And I hired Scott Estel, and he came in. He has gravitas. He walks in, he says, I used to run the Chicago division of the Internal Revenue Service. I was in charge of audits. I represent Clint, and obviously you don't know what the hell you're talking about. I think we're going to wrap this up real quick. I just sat there and I did what I was told, which is, don't say anything, Clint. I'm going to take care of everything. And he's a great guy. Yeah, he works with us for people when it comes to being audited. All right, so a few more little things here, and so we talked about how to create a plan. You must pay taxes, but there isn't a law out there that says you have to leave a tip. So when it comes to tax planning, everyone's different when it comes to their tax plan. We often think that if you do X, Y, and Z, that's it. No, it's not. A lot of it, when it comes to tax planning, is I want to know what your goals are. Okay? If I sit down with you, or someone sits down with you at Anderson, and you tell them, hey, I want to save as much as possible on my taxes and reduce them down to the lowest amount as possible. Well, one of the questions is going to be, well, how much month do you need to live on? What's your burn rate? I got one client in California down here. His burn rate is $1.5 million a year. 1.5 million. I know. You see how everybody's like, there's dead silence on when we were talking. He said, Clint, you still there? I said, yeah, I'm just trying to figure out how much that is a month that you spent. All right, it basically spends over $100,000 a month. It is a very lavish lifestyle. Now, with that type of lifestyle, when you ask for tax planning and tax reduction, it makes it a little more difficult for someone to reduce your taxes if you're burning stuff on personal expenses. Because you're not going to be able to write everything off. If you want to go to a place where you can deduct everything, I often ask people, well, how do you look in an orange jumpsuit? Okay, because you're going to be there, right? But there are ways to reduce your taxes. A lot of it requires having a C corporation. That's why I like using C corporations in my planning. They're not audited nearly as much as individuals or other types of pass-through entities, and they provide more flexibility on the tax return when it comes to taking deductions. But it's equally important that you build your plan right from the beginning. Many times what we see is this. People put a plan together, and they say, hey, Clint, look what I built. I have this horse, and you're riding around on this horse, and you think you've got your plan, and something goes wrong. And then you find out that you didn't build this end of the horse, you built this end of the horse. And it happens a lot. A client of mine, I set up the structure. You saw the boxes I created, and I showed you a holding company and all those little boxes up top. I did all that for her in Washington State. I turned it over to her, and I said to her, Tammy's her name. I said, Tammy, you've got 7 entities. You need to create 7 bank accounts. So we created the structure. She went off to her CPA. She said, Clint told me I need 7 bank accounts. I have a hard enough time just handling 1. Is there any way you can make this simpler for me? He goes, oh, absolutely. Tammy, just have one account at your corporation level, one account at the holding LLC, and your personal account. We'll just have 3 accounts. And I'll just handle everything from a tax standpoint. So corporation will collect all the money. So what it looked like was something like this. She had a corporation up here, all these LLCs down here, and then a holding LLC here like that, and then she was down here. And so the corporation collected all the rents from these properties. So it collected all the rent, went up there, and then what the corporation would do is it would pay the rental income back down here, and she would take it out to the LLC, or sometimes it would just pay it directly to her. And the CPA took care of everything from a tax standpoint, made sure that the money was allocated to the right entity for its books and record purposes. So that's a situation where it works. It worked just fine until she was sued. The corporation was sued. And she went in and she wanted to bankrupt out this company, but the court in Washington, the judge would not allow it, and he said, all of this is one common enterprise. Because the way you ran your business and you ignored the formalities of these other LLCs by not putting the money back through them, we're not going to recognize this now. So because of that, we're going to allow the plaintiff to proceed forward against all of your properties that you hold in these LLCs. So all of her properties got tagged on the corporation's lawsuit because of the way she ran her plan. She thought she had the horse, but what she'd done in creating it, she screwed it up. Yeah.
So we have a number of members here in our group that make too much per year to get a tax write-off on their properties. They have their professions, which are not real estate. And somehow it's sounding like, well, if you were deemed a real estate investor by spending enough hours or whatever, you could write them off, but because you don't, you're making too much tax-wise to do that. Can you say something?
So what you're talking about there is material participation. So each of us have active participation when it comes to real estate. And that means is that if you think about your property, all right, you do a little bit of stuff for it, you can write off up to $25,000 against your ordinary income. So of real estate losses, depreciation, things like that. Now the issue arises when you make over $150,000 a year. Because once you hit the $100,000 a year threshold, the IRS takes back 50 cents for every dollar of that deduction. So by the time you're at 150 grand, you've lost all of your deductions associated with your property, so they become suspended. You can't use them. The way around that is to claim material participation. And that's why I told you to make an aggregation election on your tax return. If you materially participate, then all of that is freed up to use on your 1040. You can write it off against all forms of income. There's no limit to the amount you can write off. However, in order to satisfy the material participation, what you have to do is spend 750 hours a year on real estate related activities. That's the aggregation election. Otherwise, they'll look at it 750 hours per property. And you have to spend at least 50% of your time on real estate related activities. So if you work for Puget, or I guess it would be PSE or wherever it is.
SEC.
SEA, yeah. I was trying to think of who was on my power bill down here. If you worked for them, then you would never satisfy the material participation test because the IRS would state, well, you have a full-time job. So all your losses are going to be suspended and you can't take them. So in those cases, what we'll do is we'll look at the spouse. So what does the spouse do? Has the spouse got a full-time job? If not, then we're going to make the spouse the real estate professional here and qualify the spouse for material participation. One of my investors, the person that I invest with, we own some property in Savannah, he's an attorney, but that's how our relationship started, is he had that problem. He said, I make over $1 million a year, and I have over 100 properties, and I can't depreciate anything because I make too much money. And then right away I looked and said, what does your wife do? She said, well, somebody's got to run all this stuff. I said, there it is right there. We're going to do this with her, change this on your tax return, and all that's now going to be freed up to you going forwards. And there's more to it. I mean, you know, the structuring, well, a lot of our structuring has other more subtle meanings to it as well that are not readily apparent to the average practitioner that doesn't do this for a living, because there's tax and there's asset protection that are layered into this. And so we're creating opportunities that you may not need them today. They're not, it's not something that you know about as to the reason why we set it up, but in the future when you call me up and say, hey, Clint, I'm thinking about selling property, and I'm told I can't take the depreciation off my other 6 properties because the depreciation that's suspended only relates to that one property. So when I sell, I can't use that. Well, then that's when I tell you, well, guess what? Based upon the way we set you up, I can free all that up for you, and I can make that available to you. We just need to make this change. And that's something that we did. I'm bringing that up because I did it about a year and a half ago. And the guy got audited, and we won.
Okay, so if the person's not married, doesn't have a wife, and they are a professional, have their own business like a doctor or a pharmacist, can you work, is there a way to do something?
No, they just need to go get married.
That's exactly right.
Is that really what
Freedom.
That's the idea, why?
It's a marriage of convenience.
I'll be one.
All right, so you have this, and then you have the other one, which is a problem a lot, is this one-size-fits-all approach where everybody creates limited liability companies. This is an Anderson retreat that I attend every year. So, yeah, that's me right there with the big tab, right? So anyways, the one-size-fits-all approach. What is the problem here? Yeah, everybody gets stares at this slide. Is that so many practitioners use the LLC as the entity that you need to set up. And it's so wrong. You know, you have to understand the real estate, their business, what they're doing. So here's some guys in Illinois. They set up, they go to an attorney, and they say, we're going to buy tax liens and deeds. What type of entity should we create? So you guys need a limited liability company. So they set up an LLC. He says it's a partnership, so it's going to be taxed as a partnership. There's two of you. Okay, great. So they went out and they started buying tax liens and deeds to get a hold of properties. They flip some, hold some as rentals, take some in, sell them on installment sales, did all kinds of stuff. They ran this for 3 years. And what they did is if they held the property for more than 1 year before they sold it, they recognized that income as long-term capital gains. A lot of those deals too were sold on 1031 exchanges. They had deals done on installment sales, meaning you take in, say you sell for $100,000, you take in $10K initially, and then you have to pay over time. And then, you know, some were short-term deals as well, that they just bought, rehabbed, and flipped. So anything that was over 1 year, they treated as long-term capital gains 15%. This is when they did this. Anything under 1 year, they treated as ordinary income, but short-term capital gains, okay, as investment income. IRS audited them 3 years ago, 2 years, 3 years ago, wherever it was. And they totally restructured their business. They said, everything that you've done is what we consider to be dealer's property. That is, you were in the business of buying and selling real estate. They said, it wasn't us, it was our LLC. Correct, but the problem is your LLC was set up as a partnership. Yep. And when you run an LLC treated as a partnership, you're a sole proprietor. So what, if the LLC is a dealer, you're a dealer. So everything that you did is going to be recharacterized as active income. No long-term capital gains, no installment sales. So that property you only brought 10 grand in, you're still owed 90 on, that's all taxable too in the year of sale, even though you haven't received it. They went through and decimated these two guys because the attorney they went with didn't understand these plans and how to work with real estate investors and what the issues are. So you got to have a strategy when it comes to creating this structure. Yeah?
If it had been in a C Corp, that might have been the solution?
C Corp would have been one of the solutions, absolutely, in that case. That would have been a multi-tiered strategy for what they were doing. But the C Corp would have been the primary motivator in that, where they would have been the one entering into all the deals on the tax liens, and then we would have been moving them out based upon what we had to do with it.
This is exactly what Anderson and Clint has done for me in my C Corp for NH Big, and that's where I got the information. Thank you very much.
Thank you. Well, great plug. And in fact, what we did for you is the exact same thing that Toby and I were doing in Las Vegas. The way we structured you was the way it was based on our own structuring. And so the strategies that we utilize for our clients are the same, many times the same strategies I've utilized for my own investments, or it's the same strategies that we've had other clients that are utilizing. Because our clients are all over the country, and they have all different kinds of investing. Things that, you know, you don't think about until you're presented with the issue. Like I had a client that was just down here buying a big flip. The purchase price on it was 1.2 mil, and it's in the middle of rehab. The guy got a divorce, and he just wants out of the deal, and so he's willing to sell. There's material all over the property. My client's willing to walk in on this deal and buy it for 1.2. She thinks she can sell it for $2 million when the property's been rehabbed. And I said, well, wait a minute, because she sent me the purchase and sale agreement. I said, this isn't going to work. She said, why not? how do you know what you're getting? She goes, I'm getting the property. I said, yeah, but don't you want all the stone that he's purchased that's hanging out, that's all stacked upside, and all the other materials that have already been purchased that are outside of the property? She goes, they're included. I said, they're not included unless you list them on the agreement. And on top of that, does he have a permit for this construction?
Yeah.
Yes, I said, and she goes, why is that important? Because maybe you can't permit it to do what you want to do, and he's been flying under the radar screen, gets red tagged, and you're going to really be out some serious cash. So these are things that,